Well, the Federal Reserve met and decided this week, and we heard from Chair Jay Powell, and it was all about inflation. At the same time, the Hoover Institution is holding a seminar right now, a conference out in California on the subject of monetary policy. And so we got to talk with former Treasury Secretary Lawrence Summers of Harvard and Niall Ferguson of the Hoover Institution, both out there. And we asked them, is the Fed starting to get it right?
I think the Fed's moving in the right direction. I think that's a good thing. Whether they're moving strongly enough and whether it's going to be enough to bring inflation durably under control, I think is still very much in question. You know, the labor market is looking very, very tight. The JOLTS data showed even higher ratio of vacancies to unemployed than we'd had before. And so I think there are still very real challenges ahead of us. I'm not sure the Fed needed to be quite as prescriptive with respect to what it was going to do in the future as it was. So I still think we've got a very difficult challenge ahead of us, and we're still in very turbulent waters.
Well, to that point, Larry, were you surprised when the chair, Jay Powell, essentially took off the table 75 basis point rate hike?
I was surprised that he took it off the table as firmly as he did, and in the same couple of paragraphs started talking about core CPI having come down and hinted towards the possibility that at some point they'd be able to move to 25s. Those things could happen, but I think the lesson of the last year and a half is that we can't predict, and therefore we mostly do damage to credibility when in official circles we make strong predictions.
Niall, you're a noted historian of the economy, of financial matters. If we look back at history, the historical track record of central banks being able to deal with this kind of inflation without going into recession is not particularly a happy one.
Well, David, I thought we'd learnt the lessons of the 1970s, but it seems like at some point we forgot them again. In the 1970s, of course, the Fed sought to tighten, but would periodically lose heart and blink. And for more than a decade, monetary policy failed to get on top of an inflation problem. It's not an exactly perfect analogy, but there are a couple of things that are really striking to me. One is that this problem began with an error of monetary and fiscal policy, which Larry, of course, pointed out in February of last year. But then, as happened in the 70s, we get a geopolitical shock on top of that initial policy mistake, and inflation expectations are then away and unanchored. And in this sense, I think the war in Ukraine is performing a similar role to the war of 1973 in the Middle East, which, remember, administered a shock not only to oil prices, but also to food prices. So in that sense, I think the analogy is quite good. And I agree with Larry. I don't think the Fed has nearly done enough, and it has a hard road ahead. It's also going to come under pressure at some point to blink if we continue to see the stock market selling off, the bond market is in trouble, and we have a much more complex and large financial system than we had in the 1970s, with a much higher stock of debt. Therefore, it's more sensitive to interest rate moves. So it's a long and, I think, very rugged road ahead for the Fed.
And finally, this was a very eventful week for central banks, the United States certainly, but not only that, Bank of England as well, and for economies. At the very end of the week, we got jobs numbers, Larry, out of the United States, and we added a lot of jobs once again. Participation rate actually went down a bit. Wages continue to go up. What did you make of the jobs numbers?
I think this was a relatively uninteresting set of numbers, about in line with what was expected. Wage growth was a little bit slower than I expected. That could conceivably be a sign of positive things to come on inflation, but that certainly wouldn't be a judgment we could reach yet. It still looks to me like we've got a very tight labor market, and we're now essentially at a ratio of vacancies to unemployment of 2. And that contrasts with a ratio that's averaged less than 1 over time. So that says to me we've got a lot of tightness that we're going to have to find a way to work off.